The government's plan to levy a 30% tax on proceeds from virtual digital assets has caused a flutter not just amongst those who have investments in these assets, but also among those who were looking at these assets as a potential future investment option. Come the 1st of April, any income from transfer of any virtual digital asset, such as cryptocurrencies, shall be taxed at a rate of 30%. While computing such income, no deduction with respect to expenditure or allowances shall be allowed barring the cost of acquisition. Loss from the transfer of crypto or any other digital asset cannot be set off against any other income. In addition, a TDS of 1% would be made on the transfer of digital assets. So what led to this announcement? How did this become such a big concern for the government that it felt compelled to come up with tax clarity on income generated via dealing in crypto assets? CNBC TV 18 dug deep, spoke to a slew of sources, and some really interesting cases came to fore. What we are highlighting here are a few startling cases which the Income Tax Department investigated and other cases brought to fore the urgency with which the government finally acted upon. Sample this. A techie by education and a poultry farmer by profession, settled in the Guntur district in Andhra Pradesh, was mining Ethereum at his farm. Tax department officers, after noting a sudden suspicious transaction of about 1 crore rupees in his bank account, raised a red flag. Investigations revealed that the techie turned farmer had set up a graphic processing unit in order to set up a crypto mining rig at his farm. The entire investigation took place last year, and the farmer is still under investigation, even though he has paid taxes along with interest and penalty on the income concealed by him. Next was a small technology service provider company based out of Bengaluru, which was paying its employees' salaries in form of bitcoins, and the employees were encashing them at a price and time suiting their requirements. Neither was the company paying any taxes, nor were the employees, as there were no monetary transactions. The Income Tax Department got an alert through their system-generated red flag when an employee suddenly had 50 lakh rupees being credited in his bank account, which usually hardly saw any transactions. This was followed by another credit of 60 lakh rupees to the same account next month. Investigations revealed that the employer had made it mandatory for the employees to receive salary in form of bitcoins, which the company was getting for rendering tech services to a foreign client. And it was a case unearthed in 2017. And since then, the tax department had kept a strong vigil on these kind of activities. Another case dates back to 2013. A housewife had started investing family savings in cryptocurrencies and was making a good fortune. Here too, a suspicious transaction of 30 lakh rupees had rung the alarm bell for the tax department, that too being received from a foreign account, that too in the account that the housewife had kept, which hardly had any savings, and neither did it see any monetary transactions in the entire tenure since the time she held these bank accounts. As I said earlier, these are only 3 illustrative examples which show the kind of cases which the tax department found, investigated, and which alerted them to what was happening with cryptos. Sources we spoke with have also told us that there are numerous other cases like the ones I described earlier, with majority of these instances concentrated in and around Bengaluru, Hyderabad, and Delhi. But sources also point out that roots of crypto transactions are equally, if not deeper, in Tier 3 and Tier 4 towns and districts across the country. And basis of these investigations, between 2017 till December 2021, IT department has carried out survey actions not just on individuals but at crypto exchanges operating in India too. Some of them are WazirX, BTX India, Unocoin, ZepPay, BetCipher Labs, CoinSwitch Kuber, amongst others.